All right. Mute is off. Live on Facebook, LinkedIn, YouTube, X, Instagram. Hello to Alan on Instagram. Drew McFarland, Mr. Aston Martin himself, checking in from Scotland, maybe. Good to see you there. What else do we have here? I need some notes. And I think we are good to go. Welcome, everybody. Happy Valentine's Day, February 14, 2025, episode 332. Welcome to Mornings Wisconsin, the best damn business show for medium and small businesses on the planet. Did you get your Valentine's Day card this morning? I did. Warms my heart from my grade sixer. Thank you very much, Emma. She wrote me a haiku. I love you so much. You work very, very hard. You are amazing. Is that how a haiku works? I'm not sure how haikus work. There's more, but the real theme to this was that I seem to work a lot, and maybe I'm not around as much as I should be. Sign of the times. Sign of the times. Happy Valentine's Day to everybody. I don't like this holiday, but it's not even a holiday. I don't like this day, but I hope you have a wonderful one regardless. Markets this morning, the U.S. looks green. Canada looks red. When I did my notes about an hour ago, it was exactly the opposite. Things aren't moving very much in the equities one way or the other right now, but Bitcoin looks like it's going to rebound, or it's positioning to rebound. Anyways, that would be amazing. There's 17 states now in the U.S. There used to be 20, actually, but there's 17 states in the U.S. right now that have legislation somewhere in process to hold reserves at the state level of Bitcoin, which, of course, Bitcoin is just a pure supply and demand play. And the more demand, the more holding by governments, including the feds and the states, is going to make a big, big difference and push that up way past the 100,000 level again, in my particular view. But remember, I do not give you personal financial advice. Don't trade on me. Do listen to me and check out my content for leadership, medium and small businesses, financing, all that sort of stuff. But personal securities trading, making your investments, That's not my bag, but I do give you my thoughts. Gold was at a all-time high earlier this morning. It's dropped a little bit since then, but it is at an all-time high. Hey, Ashley on Instagram, thanks for checking in and doing the sound check this morning for us. And silver, so gold's at an all-time high, and silver is popping $33.54 when I set up my notes for this. But more importantly, the futures on silver look like it's ready to explode even more. And I was listening to an economist this morning on a YouTube show that I check into to get content for my show, just generally what's going on in the world. And there's a commodity newsletter that's touting silver as being the number one commodity right now. I want you to remember, when you're investing in commodities and you're looking at prices, you're seeing gold explode, oil, silver, all of these commodities are priced in US dollars. And therefore, gold will go up because of supply and demand, right? There's a limited amount of supply, supply, and it doesn't grow very much, but demand can come and go, and that's going to impact the pricing. But what else? So there's a supply and demand like anything else, same with oil, right? But there's also a currency element to pricing. And remember that if you're looking at gold explode or silver explode, what you might be looking at, and I think you are looking at, is the market saying the US dollar is actually dropping or will be dropping in the future based on the Trump administration. And so it may not be necessarily about gold in and of itself, or silver in and of itself, or oil in and of itself, although there's a component of that. Don't forget the currency piece to that. Have you been following DOGE on X? Hey, good to see you. I can't pronounce your username on Instagram, but thank you for joining us. Have you been checking out the DOGE X feed? It cracks me up. The things that they are finding in the US government to cut is just astonishing. And they're posting it all on X, and they're creating actually a website for DOGE that should be out today, they say, which will do a running tally of everything that they're cutting and the government waste. I wish they were doing this in Canada as well. So there was a post this is all just from yesterday. I just canceled a $50 million Biden area environmental justice grant for $50 million to the Climate Justice Alliance, which I think, by the way, is I want to say related party. In other words, I think it is people that work for the Biden administration. They set up this Climate Justice Alliance, and then they fund it with your tax dollars. And it says this Climate Justice Alliance, which believes climate justice travels through a free Palestine. There you go. Let's just mix in what we might call woke causes or extreme left causes and fund it on related party advances. It's crazy stuff out of the Department of Education. Instead of improving outcomes for students, here's what your taxpayer dollars were going to. Ashley, listen to me. I want you to cover your ears and go la, 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 la. A $4.6 million contract to coordinate Zoom and in-person meetings. $4.6 million to set up Zoom meetings. $3 million contract to write a report that shows that the prior reports were not used. $3 million to write a report to say that nobody reads reports. A $1.4 million contract to physically observe mailing and clerical operations. Not a bad gig. You sit there and watch people mail stuff for $1.4 million. That's pretty good. That's the Department of Education. Here's another post, all from yesterday. Y'all going to love this from the DOGE report. This post says $3 million on steroid-enhanced hamster fighting. Steroid-enhanced hamster fighting. Now, tell me, why is that not pay-per-view? That should have been a profit center, right? I think it should have been a profit center. $600,000 on studying parrot romance. $2.3 million on the cocaine effects on beagles, on puppies. So they cook up these puppies, and then they study the results of that. Now, look at, I like watching coked up puppies as much as the next guy, right? I mean, that's fair to say. I think we would all like to see that. But I heard on the news somewhere else that this was actually entirely pure cocaine. They're not going buying it off the street. Somehow they've got pure cocaine coming probably out of Colombia. They're using it on beagles. And my question to you is, how much of that cocaine do you think the beagles got? Yeah. I think if you're looking for a grant to buy pure cocaine to test something, the test subject's probably not going to get a lot of that cocaine. Do you think the researchers who probably were sampling some of their own product, do you think it's them that came up with the parent romance study, that just hanging out, sampling the product, watching parrots? I don't know. I think that could be it. 500,000 on racial aggression in mice. $2.1 million encouraging Ethiopians to wear shoes. Apparently that takes a lot of money. So there you go. I don't know. DOGE, it's fun to watch. It's amazing what governments spend money on. It's amazing what any organization spends money on when it's totally out of control. So last night on the night shift, I'm sitting at my desk. I'm doing a bunch of work, and I flip on the TV in the office here. And I flipped through CNBC, which I never listened to, but everything else sucked. And I just wanted the background. And on there was Cramer, Jim Cramer, the stock and trading guru who gives you advice. I feel like it's 24/7 on CNBC. Now, I never listened to this. I'm confused here. It's CNBC, and my notes said MSNBC. That's how I got offside on that. And so I know that Cramer is the much maligned guru. I know that there is a social media trend, which is probably true, that you should just trade the opposite of whatever Cramer says. Whatever he says, yeah, I love this stock is going to go up, you should short that stock. This stock's going to go down, you should start buying that stock, probably with leverage, with options. He's basically the no respect. He's the Nickelback of trading. That's what's going on with Cramer. But I don't feel that way about him. I've never really paid that much attention. Why? Because I actually know people that know Cramer, and they know his funds, and I respect those people, and they respect him, and they say, hey, Scott, it's tough. It's tough to get on TV and have people all over the world call you with like, hey, what about XYZ and their stock? And you have to have an answer. You have to have an answer because it's TV. You can't just say, I don't know. So you come up with an answer, and you're not always going to be right. So, okay, I give him the benefit of the doubt. I had the TV on for literally 1 minute yesterday with Cramer coming through. And the very first thing I hear him say is there's a caller, and it's somebody who's clearly young. I mean, an adult, but let's say in their 20s, just going from the voice. You don't see them. And the person says, hey, I'm starting an investment fund, and I just wanted your advice on how that works and what I should be investing in terms of equities. And Cramer says, look, you're young, so you have to go with higher risk stocks, higher than I talk about on this show. That was his advice. That was it. That was the total advice. You're young, so you have to invest in equities that are so risky, I don't even talk about them on this show. And then after the kid hangs up, he looks at the camera and he says, when you're young and you lose all your money, you have time to make it back. That was his position on this. And so his advice to you is that you should lose all your money or put it all at risk until you're older. And then when you're older, you need to be safe with that money that you no longer have because you lost it all when you were young because you invested in risky stuff. I'm no personal financial advisor, but I'm a little offside with that. Remember, the magic to everything in life, and particularly in investment, is compound returns. What does that mean? It means when you're younger, you have a lot more time to compound. And that means you can go into index funds and lower risk things, and they will compound over the next 30, 40, 50 years that you have. Is completely the backwards from what I think that advice ought to be. And then he goes into, that was the first 15 seconds. And then he goes into a PEG ratio. The PEG ratio, PEG, is, and he says, he introduces this ratio and he says, there's a couple things I live and die by in trading. And one of them is this PEG ratio, and it works almost all the time. All the time it works. Not 100% of the time. He does clarify that, but most of the time, this gives me good guidance. So what is this? Well, it's a price earnings. That's the PE part of the PEG. Price earnings ratio divided by growth. So you take your PE, let's say your PE is 20, and you divide it by 10% growth, let's say. We'll use that example, and you get a PEG ratio of 2 times. And it's a valuation that's a metric that used in trading. And he says if your PEG ratio is 1 or less, then that is a stock that might be undervalued and you should buy that stock. If it's 2 or more, it's an overvalued stock and you should not buy that stock. Now, I'm not a trader. I don't wonder, I'd never heard of the PEG ratio before, but I'm listening to this and I'm thinking to myself, well, that doesn't make any sense. How does that make any sense mathematically or in substance? And again, this is like a 45-second hit. So I looked into what this PEG ratio was, and he's defined it correctly. And this is the rule of thumb. But let's just look at that. Let's say in my hypothetical example, you do have a 20 times price to earnings ratio. In other words, if the company is earning $1 per share, maintainable forever, and is trading at $20, that is a $20 price to earnings ratio, right? So you're just multiplying that. Well, what is that 20 times ratio or multiple? What does that mean? Well, what it is mathematically is the inverse of the discount or the rate of return with growth, okay? And so what does that mean? So if you have a 20 times multiple, 1 over 20 equals 5%. So you take the inverse of that multiple, you end up with 5%. And in that 5%, that would be sort of the discounting of a maintainable number forever. Well, in that earnings forever, in that multiple, in that 5% is both a required rate of return for the risk profile of that company and growth. Those are the 2 components of that 5%. And therefore the 2 components of the multiple. Now, let's not get into the weeds on this. Let's just say that a discount rate or a rate of return for this average company trading at 20 times, let's say the discount required rate of return on that is 15%. Now, in a large cap, very safe company with just long, consistent growth, the 15% is probably too high. You're probably more in this market, 10 or 12. But in our world, in a little more mid-market, smaller public companies, 15% is a good number. It's a good number, and certainly for this hypothetical example. So a reasonable rate of return is 15%. Yet we already said a 20 times multiple is actually 5%. So how did we get from 15 to 5? Well, the answer is growth, right? There's only 2 things in that multiple, and it's the required rate of return for that risk profile and the growth. And really, you're just subtracting the growth from the rate of return. And in this case, and it's not quite that simple, but it's sort of that simple. You've got a 15% required return, but you end up with a 5% is what the multiple tells you. And so your growth is 10%. It is assuming that you're growing at 10% forever. The higher the sustainable growth forever, the higher the multiple, in other words, because it is part of that. So if we have a 20 times multiple, a 15% rate of return, that implies a 10% growth rate. But the PEG, therefore, is 20 divided by 10, the 10% growth rate, is 2. This PEG calculation says it's overvalued. Remember, don't buy it if it's 2, buy it if it's 1 or less. But it's not overvalued. It's exactly valued by definition because we said our required rate of return on this is 15%. So the math doesn't make any sense. It makes no sense to me at all. I get that it's probably a rule of thumb for traders, but this is just dumb. Like there's it mathematically does not work for me. So the math is sketchy. Here's the important, and if you're a trader and you rely on this, I would love for you to tell me in the notes why this is true. But I'm just saying it's not true. But that's not even the important part. The important part is the 10% growth forever assumption. Cramer tells you to take the PE multiple divided by growth. Well, how do you know what the growth is? Is it because the company tells you we're going to grow at 10% forever? Is it because some analyst says, I assumed we're going to grow at 10% forever? It's not historical growth, it's future growth. You don't know that. Why do tech companies back in the bubble, AI companies, why are they trading at multiples of 100 times revenue? They don't even have earnings. Why is that? It's growth. That's why they're expecting they're going to explode. And when they get there, there's going to be a bunch of cash, because that's what value is. It's the cash in the future that I can put in my pocket, discounted for time, discounted for risk. And so that's what it's based on, is growth. And when a company slightly misses its growth expectations, when cloud growth is off a little bit for whatever company, when AI growth is off a little bit, when subscriber growth is off a little bit, it changes the growth assumption in the analyst models, and the stock gets hammered 35% for a 3% miss on growth, because it has this multiplying effect, because it's literally in the multiple. You got it? So growth is a huge, huge issue, and you don't know what that is. And to say, oh, I've got a formula, just divide my PE ratio, or sorry, multiple by the growth, you don't know what the growth is. You can guess, but you're just guessing. I can't watch Cramer. I can't watch Cramer. It's just ridiculous. Wall Street Journal, JP Morgan, see it. So I've been sent clips. Thank you, David, for sending me that clip this morning on the reel on Instagram. By the way, I'd seen it yesterday, and Diamond, the CEO of JP Morgan, was speaking, I think, in Chicago, and it was like a town hall thing for employees or whatever. And it was just a profanity laced rant about working from home, and how they're going to put a stop to that, or they have, or are putting a stop to that. And I was going to, sometimes what I do with these reels is I play them on my phone, and I hold them up to my computer microphone in dictate mode and Word, and it just gives me the script, and I use it for this show. But this one is it was amazing. I love this rant, but it was so profanity laced. I don't think I can use it. Certainly not its entirety. But from the Wall Street Journal, Jamie Dimon lashes out at employees who had been strongly advocating for the Wall Street giant to ease up on its 5-day return to office policy. To which Dimon says, "Don't waste time on it. I don't care how many people signed the fucking petition." Says effing in the Wall Street Journal. When asked about the in-person work policy during a town hall meeting Wednesday, according to Reuters, Dimon was referring to a petition that had been circulating among a group of workers opposed to the company's latest policies. Dimon also goes on to assert during the town hall that there is zero chance managers will be allowed to determine in-office requirements, saying the, quote, abuse that took place is extraordinary, end quote. This is just like the DOGE thing. They want people to come back to work for the federal government, and they're just finding all sorts of abuse. As he says, the abuse that took place is extraordinary. Particularly the younger people, but I think everybody, once you get into the habit, you want the big pay, you want the huge bucks that are tied to success and come along with the expectation that you're working around the clock 24/7, like the Elon Musk DOGE team does. But you just want to take the big bucks and stay at home and game the system effectively. At one point, he goes on to say, this is an important point that like years ago now on this show or its predecessor shows, when we talked about the remote work trend, that as a young professional, this is death to you. And it's death to you because you don't get mentorship, peer learning. When I was in the business valuation corporate finance group at KPMG in Toronto, way back when as really my first major gig in this sort of field, there was 40 professionals on that floor, of which I was one. And there were some really, really smart people. I like to think of myself as pretty bright, and I like to think that academically I was maybe pretty average in that group of people. And what you do is you learn from your coworkers, from your peers, right? You're trading off ideas back and forth, and this is how you work. You cannot do that remotely. You can't do that. You don't get mentorship from senior staff. You don't bond with senior staff. I made the point years ago, if you're a young professional and or just let's stick with a young professional, and you have the opportunity to go to the office or not go to the office, who do you think is going to get the promotion and the raise at the end of the year? Do you think it's going to be the professional who stayed home and worked on Zoom and just quietly did their work? Or is it going to be the professional who went to the office every day, did their work, bonded with their superiors, upper management, went out for lunches and drinks and created that relationship? I think the answer to that's pretty obvious. And so he makes that point, Jamie Dimon does. And he also makes the point that on Zoom calls, you're on Zoom in a meeting, and what are you doing on Zoom? He knows that you're looking at your phone and texting your coworkers that are also on the Zoom call, talking about how much of an asshole this other person is on a Zoom call. And it reminds me back in the BlackBerry days in Waterloo, Ontario, and you used to go for a meeting in BlackBerry, not me specifically, but vendors or what have you. And I heard these stories all the time. And you go into a room and there'd be 18 BlackBerry people, and they all be on their BlackBerries, DMing each other. What was it? Pinning, P-I-N, pinning each other about the vendor during the meeting. It was rude. It was thoughtless and counterproductive. And Dimon goes on a rant about that. Globe and Mail, Canada's Wall Street Journal, reports that more than a dozen publishers, including Condé Nast, The Atlantic, and the Toronto Star, are suing Canadian artificial intelligence company Cohere, Cohere Inc. I'm going to pronounce it Cohere. You can correct me if I'm wrong in the notes. For copyright and trademark infringement, alleging the company improperly scraped news content on a massive scale to train and build its AI models. The lawsuit was filed Thursday in New York, and it's the latest salvo between companies that produce content and those that mine huge amounts of data to build their AI software. Vox Media, Political, Forbes, and others are alleging that Cohere has used their content without consent or payment to build this technology, which can then reproduce those very same articles verbatim, in some cases, even breaking news pieces and those behind the paywalls. Cohere's models can also produce fake articles and attributed those fake articles to those sites, which makes me think. So again, let's just go over who this is. You got Condé Nast, The Atlantic, Toronto Star, Vox Media, Politico, Forbes. How could you make up fake news articles about those publications? Aren't those publications the very definition of fake news? I think that's the more interesting thing. If that's what AI is training on, is the rubbish out of those publications, how is AI ever going to be reliable if it's just reciting the fake news from those publications in particular? That's an interesting thought. Also, if I read an article, let's say I read a Toronto Star article, and let's say I happen to believe it, and let's say I go to the bar later and I'm having a drink with a buddy, and the buddy says, hey, what about this? And I recall that Toronto Star article, and I say, well, I was just reading about that, and here's my points, 1, 2, 3, 4, 5. Have I not done the exact same thing as AI is doing? Are they not just reading the data put out by the Toronto Star in that example, and then having a conversation with its users, just digital? Is that not the same thing? And then you say, well, there's a paywall. Well, what if somebody who's behind that paywall, in other words, a subscriber, summarizes that article, puts it on X, which people do all the time, and I read the X post, and we end up in the same same place. The AI isn't hacking the paywall. The AI is just looking at publicly available information and they're using it. I don't see in the long term how the news sources in this particular case survive. I just don't see it, because I just think that what AI is doing is just grabbing all of this data, and I don't think you can stop it. And it's disintermediating news. That's what it's doing. And the news guys, I think, are going to lose. They might win this battle, but in the long term, they're going to lose. Cohere copies, uses, and disseminates publishers' news and magazine articles to build and deliver commercial services that mimics, undercuts, and competes with the lawful sources for those articles, the court filing reads. Left unfettered, such misconduct threatens the continued availability of the valuable news, magazine, and media content and publishers produce. It does not put the valuable information in air quotes, which it probably should. Just remember, as AI grows, this is a serious issue. I'm not sure how it's going to fall out, but I will tell you this: XAI owns its data. That is a reason to buy Twitter, to rename it X, to create the artificial intelligence platform. Musk and his companies own the data from X. Tesla is an electric vehicle car. Yes. It's an automated driving car. Yes. But what it really is a source of artificial intelligence data from all of these autonomous driving cars going around and picking up data from everywhere. And so XAI is the only AI, as far as I know, that actually owns this data. The rest of the people are stealing data from everywhere. This is going to be an ongoing issue. This has been a Mornings with Scott on Friday, on Valentine's Day. I wish you all much love, and remember our theme of 2025: defense wins championships. Cover your butt, do your accounting, cross your T's, dot your I's. Defense wins championships, the theme for 2025. I hope you all have a great weekend. We'll see you Monday morning, 8:30 Mountain.